Welcome to the Wealth Exchange, your access to the experts addressing the issues affluent families across Canada face every day. From market commentary and planning strategies to leadership and philanthropy, we discuss the subjects that matter to you.
Hello, everyone. Thank you very much for joining me for this podcast discussion today. Clearly, markets have a way of surprising investors, you and me both, and especially after long periods of very strong returns or very weak returns. And today we're going to explore the topic of mean reversion and what it actually means for your portfolios. Joining me today is John Nicola, the Executive Chair and Chief Investment Officer of Nicola Wealth. He spent his career thinking deeply about topics like asset allocation and risk management and how to structure portfolios well so that they stay resilient in different regimes and also have the flexibility to take advantage of opportunities that might arise. So we'll listen to John off the bat, discuss some of this new research that he's done, and then I'll pop back on afterwards and ask him some few questions. So with that, John, over to you.
Thanks very much, Will. Appreciate that. And good afternoon, everybody. Mean reversion. Many years ago, centuries ago, Isaac Newton postulated that whatever goes up must come down. Sounds incredibly simple for such a genius, but at the same time, it helped him formulate his theories on gravity. And maybe a great visual way to think about that idea of things going up and automatically coming back down again is to think of a pendulum. Now, if we take a look at this example, think of returns as being similar to a pendulum. It's moving to the right, so it's already swinging upwards to the right. And during that period of time, that represents returns being above average. As it swings to the left, that eventually gets to a point where the returns are below average, maybe for an extended period of time. And then if we take a look at the middle, on average, when we take a look at all of the various points of this pendulum, on average, they point downwards. That is the mean. In other words, whether returns are strong or whether they're weak, they will mean revert. They will come back to the middle. So let's look at the points that we're trying to make in this presentation today regarding mean reversion. So first, it's a tendency of asset classes to move back toward long-term average returns after extended periods of strong or weak performance. When markets correct, they often overshoot, much like a pendulum, amplifying volatility and testing investor behavior. And just to use the pendulum metaphor again, the option of overshooting is not something that's accidental. It's actually created by the force of coming back to the mean. In other words, gravity is driving the overshoot. Historical data across public equities, private markets, real estate, infrastructure, and bonds all show a consistent pattern. Periods of exceptional performance are often followed by muted or negative returns. Periods of poor performance, on the other hand, tend to create the conditions for strong recoveries. Today, many public equity markets are trading at near or record valuations, increasing the risk of future mean reversion. By contrast, several private asset classes, including real estate and infrastructure, are emerging from below average return environments, where mean reversion may work in investors' behavior. Disciplined, diversified asset allocation grounded in both public and private markets can reduce the volatility and reduce long-term outcomes. And this is the foundation of our core approach designed to compound wealth over full market cycles rather than chase short-term performance. Now, this is what our core portfolio looks like. It's very balanced between fixed assets such as public assets in both equities and fixed income, private capital also in fixed income and equity, and real estate. So when we did this analysis, one of the things we wanted to do is gather information from as many sources as we could. The process we went through looks like this. We wanted to define objectives. Is there a pattern in the way returns work in different asset classes? Then we wanted to collect data, which we did from a variety of sources. And we wanted to then make sure that the data we collected was relevant to the analysis we were actually doing, make sure that it was clean. We then take a look at what that exploratory data analysis showed us, And we came up with a statistical summary of, oh, we are seeing patterns here that maybe allow us to reach certain conclusions. And then the last thing we did was what we're doing today, which created a visualization and a communication of the information we found and the impact mean reversion has on returns for a variety of asset classes. So we looked at 8 different asset classes, and we were looking at periods of time when they had exceptionally good results and periods of time when they had exceptionally poor results measured in 5-year increments. We took a look at the S&P 500 total return for US stocks, the S&P TSX total return for Canadian stocks, the Cambridge Private Credit Analysis, Cambridge Private Real Estate, Cambridge Infrastructure, Cambridge Private Equity, the Market Box High Yield Index, and the Bloomberg Aggregate US Bond Index. If you're not familiar with who Cambridge is, they're a firm that's been in existence for a little more than 50 years, and that's since 1973. They provide advice to large institutions, ultra high net worth families on asset allocation and data and analysis, and they have an extensive amount of information on a variety of asset classes. So we used a lot of the data, especially in the private capital and real estate areas. So let's take a look at the S&P 500 total return. So we measured the period of time from 1926, a century ago, to today. And essentially the average return has been, including dividends, roughly 10.5%. Now, let's take a look at the 5-year periods of time when the S&P performed its best. You can see the first one is 1999 and the last was 2013. And in those periods of time, 5-year annual returns were anywhere from 28 to 18% per year, for an average return of 22.27%. That is double the actual average rate of return. Needless to say, in the next 5 years, immediately following the best 5 years, we measured the rate of return and we found that the average was much lower at 3.41%, almost 19% a year less in the immediate 5 years after the best 5 years. Now, what if we reverse this? What if we take the worst 5 years? So we can find years during the Depression, of course, 1932, 1941, but even more recent periods of time like 2011 after the Great Financial Crisis or 2004 after the dot-com bubble. On average, the worst 5 years came in at minus 5% a year, and the next 5 years after that came in at 12.4% a year. So there's almost a 17% or 17.5% difference in returns between these two periods of time, one following immediately after the other. We look at the TSX, the long-term return rates since 1956 are about 9.5%, and we see a similar pattern. The best 5 years, almost 23% a year. The worst 5 years, the 5 years following that are 2.14% or 20% a year less. And on the worst 5-year periods of time, the returns are 0% for the worst 5-year periods of time, followed by 16.39% in the immediate 5 years after those poor performing periods of time. If we take a look at private credit, we wouldn't expect to see as much of the volatility here, but it's not insignificant. If we take the worst 5 years, we see returns are only 5.29%. They almost double in the next 5-year period of time after that kind of poor performance. If we take a look at real estate, the gap is much wider. This is over a 40-year period of time from 1986 to 2024. You can see the differences are significant. Average returns of almost 16% a year during the best 5 years, dropping to 2% a year in the 5-year period following. On the other hand, if you have the worst 5 years, the returns are basically zero. That's 0% a year for 5 years, followed by returns of 12.84% per year in the immediately following 5-year period of time. Private equity, you'd expect to see something like stocks, and we do see it similar, not quite the same volatility, but it's pretty close. Average returns of almost 24% a year for the best 5-year period of time, followed by returns of a not terrible 9.59%. But the average return for that period of time, also roughly a 40-year period of time, is 13.4%. So it's below the average. If we take a look at the worst 5-year periods of time, it's 6.7%, about half the long-term average, followed by periods of time after that of 17% a year. So again, relatively wide gaps in performance. Infrastructure is a safer investment asset, tends to have lower volatility, and you can see it here. While the average returns over 5 years are 12.41% for the best periods of time, they drop by about 5% a year to 7.42% for the worst. The gap is a bit wider when we look at it the other way around. In the worst 5 years, the average returns was almost minus 2% a year, followed by returns of over 10% a year in the next 5-year period of time. And finally, let's take a look at something relatively benign like bonds. And the 50-year rate of return on U.S. aggregate bonds is 6.5%. Some of those periods of time definitely higher interest rates than today. The best 5 years was 13% a year, followed by a rate of return of just slightly better than half that of 7%. If we take a look at the worst 5-year periods of time, the returns are just barely above zero against the next 5 years after that of over 9% a year. So there are still big gaps in what is considered a relatively safe asset. And then finally, in high yield bonds, the gaps are 10% for the best 5 years, followed by 5.6% after that. And they are only 1.5% a year for the worst 5-year periods of time, followed by 7.08%. So again, a large degree of volatility and the same pattern being seen in all of these asset classes. One other factor to consider when we're looking at stocks in particular, and U.S. stocks in particular, is the Cape-Shiller PE ratio. It measures the trailing 10-year PE ratios for U.S. stocks. It actually goes all the way back to the 1870s. And there are a number of peaks where PE ratios are expensive, and then they're typically followed by some pretty drastic drops in markets to get back again to this mean average over time. Now, today, we're at a Cape-Shiller PE ratio of over 40 in January 2026, only exceeded by the levels of the dot-com bubble back in 2000, and much higher than 1929 and higher than pre-COVID. So this is one of the most expensive markets we've seen for public equities. This next slide is really focusing on US and Canadian REITs as an alternative to investing in real estate versus, let's say, the private kind of real estate funds that we offer our clients through our Canadian real estate and US real estate funds. And what we're looking at is a period of time since inception of these funds. In the first case, we're looking at the Canadian real estate fund for the last 20 years. And you can see in the black line, that is the rate of return and how it's been achieved. And the blue line is the actual TSX REIT index. It's an exchange traded fund you can buy. I've circled some numbers here that I think are important. The first is that the overall rate of return difference is more than 2% per year, creating a cumulative return that's almost double. Most importantly, the standard deviation of volatility, that's representing how much risk are you taking to achieve a certain result, is only 20% in our private real estate income fund versus what we would have achieved if we'd chosen to use REITs to invest in real estate as an alternative. On the US side, we see similar patterns. And again, the gap is approximately a little bit less than 2%. It's about 1.5% a year. But over the last 10, 15 years, it has been enough to basically create about a 50% difference in total return. And again, about 20% of the volatility that public markets would have created. So this represents the real reason why we chose private assets for real estate as a way of acquiring real estate as a long-term part of a portfolio as opposed to public ones. The other thing we have to compare is if we are investing in private real estate, how do we compare to other organizations or institutions that invest in private real estate? So one of the things that we are part of is the Morgan Stanley Capital Index Real Canada Index for real estate portfolios. There are 9 members in this group. We are one of the institutional members. And what you're looking at here is rates of return for that period of time on a year-to-date basis. This is as of September 2025. Then it shows 1-year returns, 3-year returns, 5-year returns, and 10-year returns. What you'll notice is that for all of the participants, returns for the last 3 years have been well below, let's say, the 5 and 10-year outcomes. So if you look at us, for example, we're at 2.1% average over the 3 years, but we're almost 8% a year over 10 years. So that means that this is a perfect example of real estate mean reverting. But what this slide also shows, when compared to our peers who also invest in large real estate portfolios, in this case, this is Canadian, that we have been able to outperform them over 1 year, 3 year, 5 year, and 10 year as a result of our approach and model and platform that we have built. So this brings us to our portfolio, which is our core portfolio. This is our collective asset allocation model. And basically, it's made up of a variety of asset classes, including cash, bonds, high yield bonds, mortgages, private debt, private equity, Canadian equity, foreign equities, and real estate. The various things, the very categories we just looked at, and the mean reversion statistics as well. And what we can see is the following. There are no negative years in this core model since 2013. It's a very low volatile model. It's designed to take advantage of mean reversion because certain asset classes will outperform others at certain periods of time. And 50% of the long-term results come from a combination of income, rents, dividends, and interest. That's part of the reason the volatility is so low, because the income of an asset class is significantly less volatile and much more predictable than the price of that same asset class. Now, a good example of where the private assets fit in is maybe to compare our own Canada pension plan with the largest sovereign wealth fund in the world, which is the Norway's oil fund. Now, here are the returns, the 10-year annualized returns, CPP outperforming the Norway oil fund, 8.8 to 6.7 per year. And we're talking CPP is currently roughly 740 billion Canadian dollars. The Norway oil fund is 2 trillion US dollars. So these are huge, huge investors. Now, what's the difference in the way they invest? Well, let's take a look at the asset allocation. The CPP fund, you notice that long part of the bar there is black. That represents private assets. It's 50% in CPP. That includes private debt, private real estate, private equity as well, and infrastructure. In the CPP funds, is less than 10%. And that has been the reason for the difference in performance over the last decade. If we take a look at the data from the U.S. Family Office Asset Allocation for last year, we'll see that wealthy U.S. families had this asset mix as of the end of 2025. Public equities, about a third of their portfolio. Private equities, slightly less. Real estate, 18%. Fixed income, 9%. Cash, 5%. Private debt, 3%. So that means on balance, they're also almost at 50% in private capital assets. Now, when we take a risk return, this is a risk return chart that's put together by Ares Wealth Management. And to be fair, they recommend and sell private assets, primarily private debt, but not just limited to that. And if you take a look at the graph, it's a little busier, but basically, if I go from left to right at the bottom, I'm taking higher risk to achieve a certain result. If I go from the bottom to the top, I'm getting a higher return. So your objective is to be somewhere in this area. See this shaded area here? This is your target zone in terms of portfolio management. Reduce risk, higher relative returns. And of course, they make a case for private equity buyout and private credit. They all fit into this area, but this is the one we can focus on. The issue of private real estate and considering the much lower level of risk, as I pointed out earlier, when we're comparing it to public REITs as an example. And then public equity over here compared to private equity over here over an extended period of time. The other problem with equity markets is that basically they're shrinking. So the amount of options you have in public equity markets has actually been shrinking for quite a few years now, almost 30 or 40 years. Take a look here. Of the 21,000 U.S. large market businesses, 13% are public and 87% are private. Of the 200,000 mid-market sized businesses in the U.S., 99% are private. So if you want to participate in this marketplace, it's a little difficult to do it on a diversified basis if you're only considering public assets. And this is an example. Even though the value of assets has grown dramatically, the public markets, the valuation of public market stocks is almost $60 trillion as of the beginning of 2025. But the number of stocks, it peaked in the late 90s and has shrunk since then from roughly about 55,000 to roughly 38,000 in that period of time. And since 2000, when we compare ourselves to traditional balance funds, this is the Morningstar Neutral Balance Portfolio and also major stock indices in the world, including the S&P TSX and the S&P 500 in Canadian dollars. You can see that our outperformance is slightly less than 2% a year over the 20 years involved here. Now, the difference here is this 6.95% represents our clients' actual returns. So this is not a theoretical model. These are the actual results measured in hindsight. The Morningstar Canadian Neutral Balance is a theoretical model. That's what the balance funds did earn, but it's not what the investors in those balance funds earned. Typically, because of what is known as the Morningstar or the Dalbar effect, returns are 1 to 2% per year below that for the average investor. So if you want to get more information about our analysis we've done regarding mean reversion in markets and other data related to performance and building portfolios, this report is on our website. You just go there now, just download it or read it if you like, and hopefully it'll provide some additional information that will be helpful in how you put your portfolio together. So I want to thank everybody for your time this afternoon, and I'm going to now hand this back to Will to continue our presentation. Will, you.
Thanks, John. Really appreciate that. Thank you for your insights as always. Before we get into the discussion, maybe I'll just sort of set the stage. You've walked us through some research that looks at a very old idea of investing, this mean reversion, but I think you've sort of helped to bring it down to the practical level in our world, so public markets, private markets. And the core question I think that people are left with is, what happens after strong periods, and then what opportunities emerge after weaker ones, and how we can take advantage of those. So maybe I'm going to just come back to something you mentioned right near the end. It seems to me that there's a lot of investor behavior involved here, and the concept of like fear of missing out in very strongly performing markets. And you mentioned something called the Dalbar effect, which you've talked about before. Maybe you can just sort of give us a bit of a rundown on how the Dalbar effect plays into this, and whether or not it's an impact at all from this research.
Sure. Well, Dalbar is a consulting organization out of Boston, and they've been doing analysis on investor results and performance for well over 30 years. And typically what they'll do is they'll take a look at a group of typically not less than 10,000 investors, and they'll look at their portfolios, and depending on what they're investing in, whether it's bonds or stocks, whether it's foreign stocks or U.S. stocks, and they'll say, okay, let's compare their returns, their actual results over these 10,000 accounts with the markets that they're actually investing in. So if you think about it rationally, if all of these 10,000 investors had some money invested in American stocks, or specifically the S&P 500, you would expect their performance to be similar to the S&P 500 because that's what they're investing in. And there is a similarity. But every year, and this is every year without fail, there's been no exception to this in the entire time they've been doing the analysis, there is a lag. So because investors' actual returns are roughly 2 to 3% per year lower in the index they invest in, or the funds they invest in, or whether it's, and that applies as equally to fixed income and bonds as it does to stocks, so that their results are considerably worse. So the point of the Dalbar effect is to say, why is it worse? Not whether it is worse, it is worse. So if I say, okay, well, I would have done better being in the stock market because I would have averaged, like I mentioned, 10.5% a year. That's correct. But you, the average investor, would have not made 10.5% a year. You would have made 8% a year, because there's a tendency for you to chase returns. So maybe accelerate or get more aggressive as markets are rising. And then as markets fall, you tend to panic and liquidate. And that way when a recovery takes place, when mean reversion takes place, you're not there to participate until later. These results, I mentioned Isaac Newton. Isaac Newton managed to lose 20,000 pounds, which is the equivalent of well over 3 million US dollars today, simply because, as arguably the world's most intelligent man at the time in 1600, he managed to lose 20,000 pounds investing in the South Sea bubble. And strangely, he invested money. He actually took it off the table and made a profit. And the stocks in the South Sea bubble companies kept rising. And so he couldn't stand it. So basically, he had to put all the money back. And certainly, this is like 9 months later. Sure enough, it kept going up for another 6 months and then completely imploded. And he lost all of the money and all the original profits he'd made. And what was his phrase he said at the time? He said, "I can predict the movement of the heavens and stars, but not the irrationality of human beings." And so he's talking about the human condition. So this has been around for centuries, this issue of how we react to respond to manias. And the more dramatic the mania is, the more dramatic the Dalbar effect is. So last year, for example, Dalbar, in their report, pointed out that in 2024, when the S&P 500 was also really hot, the gap, which is normally 2 or 3% a year, was over 8 that year. So investors underperformed the S&P 500 in that year by 8% because of their own second guessing their own decisions. So that's the Dalbar effect. And Morningside has done similar studies as well in Canada and the US and come up with similar numbers. So it's pretty well a confirmed phenomenon.
Interesting. It seems like they're doing the opposite of the mean reversion, of what the mean reversion analysis would say.
Of course, yeah, because you're chasing your momentum. So basically, you're saying, okay, whatever's moving the most up now, I'm going to buy, and whatever's moving the most down now, I'm going to sell. And if you think about the rationale behind that, of course, everybody says, well, wait a minute, how did Warren Buffett make money? Well, gee, I guess he bought low and sold high. That's kind of why his performance over 60 years is higher than the S&P 500. And he's not trying to make it complicated. He's basically saying, well, that's what you have to do. That's what contrarian investing means. But most people can't get their emotions in check sufficiently well enough to be able to act that way, even if they intellectually know it's the right thing to do.
Sure, they may sort of know that I shouldn't do this, but I just can't help myself.
Yeah, basically, yeah. And sometimes they even talk a really good story as well. They'll say, okay, I know I'm going to do this. Next time this happens, I'm going to be ready. And in that crucial moment when decisions have to be made, that's when there's that risk that they'll bail on that commitment.
Yes.
Right.
And I bet you Isaac Newton didn't tell all his friends about all the money he lost.
No, I'm sure he kept it pretty quiet. And luckily, I don't know, maybe because, he was actually, by reasonable standards back then, a wealthy man. So, he finally wrote about the story to a friend of his many years later, and to tell him the entire story. So the reason we know about the story in history is because it's in his own handwriting, that this is exactly what he did and how he did it.
Interesting. So let me take this sort of to the next step in terms of how we do things here at Nicola. It seems like part of the challenge here is trying to determine when we're going to shift from sort of a very strong period to a weaker period, and that's how sort of I think you and the asset mix committee would sort of try and benefit from our mean reversion research. And you had a slide up about the Cape-Shiller PE ratio. Yeah. Is that the type of indicator? Like, can you give us a sense of how do you try and take advantage of mean reversion, and is that the type of indicator you look at?
All right. Well, it is, and of course, we're not market timers. If I say we should maybe reduce our exposure to U.S. equities, it's not because I'm predicting the U.S. market's going to crash. At some point, it will absolutely go through a correction, whether it's a bear market or a correction and stuff like that. It has to mean revert because that's just the nature of the beast. When that happens, I have no idea. All I know is that if it's considered more expensive now than its average over a period of time, I want to participate less in that market, whatever the asset class is. So in certain asset classes, that becomes more difficult. And I'll be the first to admit that in private assets, because of their illiquid nature, it is harder to reduce your participation in them unless you try something a bit more systematic. So, for example, in the case of real estate generates income, rental income, and then there are sometimes also cash disbursements as a result of the sale of assets occasionally. So most people who own real estate typically will just reinvest that money back in their portfolio of real estate. But let's say you wanted to rebalance and you said, okay, gee, it's been a pretty good ride for real estate in the last 4 or 5 years. I'm thinking that maybe it's getting, it's outperforming all of the other classes. Like this is what happened during the 2019 all the way through 2022. It was that 4 or 5 period of time. It was really blowing the lights up. And stocks were going through a lot of periods of volatility. First it was COVID, and then it was 2022. So, some tough years back then for stocks. And if you took the income component of your real estate portfolio, which generally over the long term is about half the return, and said, I'm not going to plow that back into the real estate. I'm going to take that money, that cash flow that's coming out of that asset, and I'm going to distribute it. You can do the same with private debt. You can do the same with private equity. As disbursements come out, you can say, I'm not necessarily going to reinvest back in because I think we're at a point in time where it's more expensive than it has been. If I've earned a 12% a year return in private equity for the last 5 years in a row, and that's above my average long-term return, I'm going to say, okay, maybe it's time to take some money off the table. I don't necessarily have to liquidate the asset and trigger a lot of taxes and other things and deal with illiquidity things. I can just take the cash from it and say, okay, I will put that somewhere else, and it will automatically over time rebalance itself. So there are ways that these things can be done. Rebalancing is probably one of the easiest free lunches investors have in terms of getting long-term, safe, regulated returns.
Interesting. I was planning on asking you sort of a bit of a retrospective, like how this has informed your investing and our investing here at Nicola, and changed it for the future. And you bring up the early 2020s in real estate with very, very strong performance, which we benefited from, and it was great. Is this work on mean reversion, does this help sort of to inform your future rebalancing style and methodology to try and have that cash flow be part of like more of a dynamic situation to ensure that we are rebalancing automatically?
I think, that's completely correct. And I think probably, if anything, we could look back in hindsight over the last 5 or 6 years and say, you know what, we should be more aggressive with that. And so rather than go through a liquidity event, because I think first off, we have a lot of families that are, very wealthy families that own large real estate portfolios, and they don't sell. On the other hand, what they might do is take the income they're earning on their portfolio, and as opposed to keep buying new real estate, that money goes into the bank or goes into pay off debt and stuff like that, and it becomes effectively dry powder. And so even though they don't want to be in stocks or they don't want to be in other asset classes because real estate is what they know and understand, they're not necessarily plowing it back into real estate in an expensive market. So I think effectively that's another way of dealing with mean reversion. You're basically parking the money. And I think in this case, we as an organization can take any asset class we have and say, look, it's been great, it's a good run. Time to take some money off the table by taking the cash flow and putting it in some other safe place. And that could even be deciding to increase one's cash position if it's not obvious that there are other asset classes that really are distressed that one should be buying.
Mm-hmm. Yeah, that's something I was going to ask about. Like that, I like that concept of sort of it gives us some dry powder. And I wondered, like, what would we do if all of our asset classes were performing very well? Would we be faced with removing from one and investing in another that also is on a 5-year cycle? So, or what you're suggesting that perhaps it does make sense to raise some cash to be tactical.
We have the data, so we know what normal returns look like, and we know that generally speaking, even if we add value, so when I say we can add value to our returns, look at the example between ourselves and the REITs, for example. So in the case of our Canadian real estate fund, our return difference is like 2% a year, which is hardly irrelevant. It's a material number.
No, it's big.
But nevertheless, it's 2% a year. So let's say that, okay, the average REIT return was, let's say, 6.5%, 7%, and the average our real estate returns were 9. If our 5-year returns in real estate are 12.5, we're over our own numbers by a fairly decent margin. And so that's a reason to say, okay, we should be systematic, and maybe even before we get there, systematically over that period when it was above average, say, we're no longer going to reinvest that extra return back into that asset class. Now, if all the other asset classes are doing well, then you're right. I mean, generally speaking, probably certain things you could safely put the money in and they would be neutral. So you could put them into bonds, typically. You can put them into mortgages. You can put them into cash and say, okay, I'm not earning maybe the return I would have earned in stocks or real estate, but I'm relatively liquid and I'm also positioned when some corrections occur in these markets, which inevitably will be the case.
That we could take advantage.
Yeah.
So maybe let me ask you something that you and I both field this question, I think, a fair amount. So I'm curious your thoughts on it. The U.S. equity markets have done well, international equity markets also, but AI is so topical, and I've had people say to me that the market is becoming very concentrated in these AI names, and I know we talk about diversification a lot, but how do you react to the sort of this time is different story that the world has changed, and perhaps this research that, and you can comment on the time period you looked at for this, perhaps it's going to be invalidated in the future. How do you feel about that?
Well, I think AI is interesting because I think a lot of people feel we've never seen anything like this before, never anything so revolutionary. And I thought, okay, well, that's interesting. If I think back just over the last couple of 100 years, and I think, okay, well, is AI more revolutionary than electricity, than flight, than trains, than automobiles, and television, or before that, radio? So I'm going to make a case to say, okay, it is unique and special and has an impact, but at the end of the day, we have had some history of extraordinary innovations that have taken place that really have transformed the world. And back in the dot-com bubble, the problem wasn't whether or not the internet was going to be a significant part of our lives. That was pretty clear from the 90s on. The issue of how it was going to be that way, and whether some firms got overhyped, and whether too much infrastructure was built for the demands and the applications that were actually going to come along later on. So we built this infrastructure, the ability to transmit information at huge levels, but you still needed a Netflix to actually stream the information, to actually make a business out of it. And so,
thank goodness for Netflix.
Yeah, thank goodness for that. And that's just one example, right? And so you've got a situation here with AI, incredible potential, incredible applications. The problem is that the cost of building the infrastructure is in the hundreds of billions, if not trillions of dollars, over the next 5 years, in terms of the data centers and the electricity to support it and everything else. And you've got, then the question is, where are the applications that are commercially viable, turning companies into it? I understand companies using AI. I can even see them using it where they think it's going to create some productivity, although that's been a little debatable. But I think staff and people like to use AI, but I don't see where the commercial applications are. So in other words, I don't see, if you think about Microsoft, for example, when Microsoft created Office, they created a license effectively to print money for the next 25 years, and they're still printing the same money. Okay, so that means that was an application that became universal and completely chosen. We haven't seen that in a serious way with AI, but we have seen massive investments in AI. So will there be a day of reckoning until we see that second stage? I think maybe we would. And, when again, coming back to multiples and stuff like that. So we've seen some correction in AI stocks and some Magnificent Seven stocks over the last, 4 or 5 months. I'm not going to be surprised if that continues until such time as AI companies can demonstrate that they've really got some commercial platform that generates a serious amount of cash income.
Sounds like a decent amount of uncertainty on what the outcomes actually look like.
Yeah, I mean, I would say this, Will. I mean, it seems to me that AI is real. AI really has the capability of doing some amazing things, then somebody is going to develop a series of applications that are really going to make a difference. I mean, I think even in our industry, for sure, I can see AI being actually a game changer in a number of areas. That's not today. Nobody's delivering to us any applications using AI that immediately change the way that we can be productive as a business. Doesn't mean to say it won't happen. I think it will, but will it be 2 years from now or 5 years from now? Don't know. It's just not likely to be tomorrow.
Fair. So maybe just one last question before we wrap up, just about your outlook. So, given all this work that you've done and the learnings, maybe you can share with our clients how you feel about the next year for us.
Yeah, I have to admit, I'm more than a little nervous about the next year. I mean, part of the reason is the excessive performance of equities on a global basis. I'm not really picking on the U.S. because arguably last year Canadian and international equities out the U.S. So it's not a U.S. issue alone.
True.
When I think of that combined with the geopolitical issues, which I think are quite a significant risk, and don't seem to have obvious closure or end at this point in time, I think when you combine these two things together, you're looking at, let's say, a minimum of volatility in any number of markets. And so I would say that this is not a smooth sailing kind of environment. People should expect a bumpy road, I think. And who knows what the triggering events are going to be. I mean, obviously, as you and I are speaking today, it's a Monday, it's March the 2nd, and we've just had a weekend of, a war starting in the Middle East, right? So these are material things. Basically, that war wasn't expected a month ago, right? So, but now we're in a situation where it exists. And so I'm suggesting that uncertainty, along with the relatively expensive levels of equity market, would suggest we should be prepared for a notable level of volatility, especially in those markets.
I agree. It certainly makes me feel like I'll be able to sleep better at night with our sort of diversified approach. Over the next 12 months. So why don't we leave it there, John?
Okay.
Thank you so much for taking time. As an observer watching you do the work, I get the sense from you that this isn't sort of to try and make bold forecasts, but that it's to inform our understanding of likelihood in markets and behavior, and that we will see capital markets move in cycles, and we're positioning to be able to take advantage of them.
Yeah, and I think there's a lot of good metaphors that explain this, but my favorite one is a casino metaphor, which is this: is that if you operate a casino, you allow people to come in, and it's a nice place, got great entertainment, expensive to build, so somebody had to pay for that, and it's really simple who paid for it. The people who walking through the front door paid for it. And the reason they paid for it is because they were willing to gamble their money at games where the odds are actually against them. They're not massively against them. There's only maybe a 5% differential or 7% differential, but it's enough that over a period of time, the odds are probably going to work in favor of the house. It strikes me that what investors want to do now is take all the data they can, all the information, this is just some of it, and say, what do I have to be in the same position as the house is? So I don't want to be the gambler. I want to be the casino. And if you're going to be the casino, what are the things that give you the probability that the outcomes are going to work in your favor? And that's what mean reversion is about, along with other things and other strategies that you apply in a portfolio. And that's really what we're about, is to try to get that to be the way the model works.
That's great. I appreciate it. And thanks for the great wrap up, John. And thank you, everyone, for listening, and hopefully it gave you a bit of a clearer sense of how we're thinking about the world right now. And as John mentioned in his slides, we have on our webpage the full report that he's worked up. And please reach out to your advisor if you have any questions. Thanks very much, everyone.
Thank you.
Thank you for listening to another episode of The Wealth Exchange. You can view today's show notes and subscribe to the podcast on our website at nicolawealth.com/The Wealth Exchange. Some of the companies or securities mentioned during this episode may be held at the time of recording by Nicola Wealth. Please view the show notes for full disclosure of our position in these companies. This podcast contains the current opinions of the presenter, and such opinions are subject to change without notice. This material is distributed for informational purposes only and is not intended to provide legal, accounting, tax, or specific investment advice. Please speak to your Nicola Wealth advisor for advice based on your unique circumstances. Forecasts, estimates, and certain information contained herein are based upon proprietary research and should not be considered as investment advice or a recommendation of any particular security, strategy, or investment product. Nicola Wealth funds and limited partnership returns are net of fund expenses charged to date. Any discussion of past performance is not indicative of future results. All investments contain risk and may gain or lose value. Projected returns are estimates only. Returns are not guaranteed. This is not a sales solicitation. This investment is intended for tax residents of Canada who are accredited investors. Residency restrictions apply. Please read the relevant documentation for additional details and important disclosure information, including terms of redemption and limited liquidity. Nicola Wealth Management Limited, Nicola Wealth, is registered as a portfolio manager, exempt market dealer, and investment fund manager with the required securities commissions.